In the 1980s, Wall Street trading floors ran purely on gut instinct, entirely blind to mathematical risk exposures. That blind spot cost Larry Fink his job. In 1986, a back-office calculation error caused his department at First Boston to bleed $100 million in a single quarter. This failure birthed a fixation. Fink realized that survival in institutional finance required shifting from human intuition to a system that quantified risk with mathematical consistency. In 1988, he founded BlackRock with a distinct mandate: master risk. He immediately hired engineer Charles Halleck to build a digital system capable of mapping every vulnerability in a portfolio. They called the project Aladdin. Its first iteration ran on a single Sun Microsystems workstation, famously wedged between a refrigerator and a coffee machine in their one-room office. This diagram shows how the system worked, using Monte Carlo simulations. Aladdin would take a single asset and run thousands of randomized mathematical scenarios, predicting how a portfolio would react to massive market shocks or black swan events. By replacing raw intuition with predictive analytics, BlackRock created a structural advantage over every other trading desk in New York. In 1994, General Electric hired BlackRock to analyze a highly toxic mortgage portfolio held by the brokerage Kidder Peabody. During the audit, BlackRock realized their in-house software was miles ahead of anything the rest of the industry was using. They decided to lease Aladdin's risk modeling technology to outside institutions as a standalone service. Charging competitors to use their internal nervous system proved to be an incredibly lucrative strategy. Providing the actual infrastructure of finance scaled faster than accumulating traditional assets under management. The real test arrived during the 2008 financial crisis. Global banks began collapsing under the weight of unquantified toxic mortgage assets that their internal risk departments had failed to measure. BlackRock's portfolios held up remarkably well. Aladdin's precise analytics had mapped out the exposure before the crash, keeping their assets largely insulated from the meltdown. The situation grew so dire that the U.S. government and the Federal Reserve hired BlackRock. They relied on Aladdin to untangle, value, and manage $1.25 trillion in toxic assets offloaded from collapsing banks. The U.S. government's decision to outsource the cleanup of the crash established Aladdin as the essential analytical framework for the global financial system. This chart illustrates the platform's explosive growth. BlackRock manages $14 trillion of its own assets, but $25 trillion in external assets are managed on Aladdin, roughly 8% of the global financial system. Over 1,000 organizations feed into this network, including direct competitors and massive corporate treasuries like Amazon and Apple. Once an institution wires Aladdin into its trading systems, custodian banks, and compliance frameworks, the cost of switching becomes prohibitive. Ripping it out means replacing the firm's central nervous system, leading to a 98% client retention rate. To process millions of daily risk calculations across every asset class, the system has migrated from that single 1980s workstation into a multi-cloud architecture hosted on massive AWS and Azure servers. Aladdin has evolved into the de facto operating system upon which the global economy functions. BlackRock is now aggressively expanding beyond public equities. Through multi-billion-dollar acquisitions like eFront, Preqin, and Global Infrastructure Partners, they are piping high-margin private markets and alternative investments directly into the platform. They are also layering in generative AI. With a tool called Aladdin Copilot, portfolio managers can now query complex risk exposures across these vast datasets using simple natural language commands. These technological advancements give BlackRock the reach to direct the flow of capital and influence climate transition policies on a global scale. Today, over 17,000 traders across competing global institutions base their daily financial decisions on the exact same risk models generated by BlackRock. If every major organization uses the same algorithm to evaluate risk, they all share the same correlated vulnerabilities. The tool Larry Fink built to protect his own firm from market chaos has grown completely ubiquitous. By standardizing the way the world calculates risk, Aladdin has become the single largest point of systemic vulnerability in the global economy.